And welcome to Flipping Economics. Today we're going to look at monetary policy. So we saw that monetary policy involves money and the Reserve Bank. So in terms of money, there are three reasons why people keep money. And it's for transaction services, for precautionary motive, and to speculative with it. So in terms of the demand for money, you get two types of demand. You have demand for active balances and you have your demand for passive balances. Now your demand for active balances looks like this. You have your exchange or your interest rate on your y-axis and then your money supply on your x-axis, and then you have your demand curve, which is horizontal. Now the reason for this is your demand for active balances is not dependent on your interest rate because you use it for transactions and also precautionary motives. So if you're going to the store to Pick n Pay or to Checkers to buy a Coke, you're not going to look at what is the interest rate. You're just going to buy it. It is a transaction. Or your precautionary is you save about 50 Rand each month. You put it under your mattress just for in case you need to change your tire or fill in your petrol tank or you need to go somewhere. Then you have a little bit of money saved away for that precautionary motives. But you're not going to typically look at your interest rate to see if you can do things, you buy a Coke or change your car's tires. Passive balances, however, your demand for your money is dependent on your interest rate. So it looks like this. So if the interest rate is high, money supply will be low. If your interest rate is then low, your money supply will be high. Because if the interest rate is very low, you're not going to get a return on your money. So you would rather buy something that will give you more value in the long term. Where the interest rate is high, you want your money in the bank because you want it to generate some interest. So this is for your speculative motives. Right, so if we combine the two graphs, you get your combined money demand with your interest rates and your money supply, your quantity of money. Let me just see if I renamed this correctly. Right. Okay, so now we can look at money supply. Now, money supply is also fixed horizontally. So let me show you. You have interest rate, and then you have your quantity of money, you have your money demand, and then you have your money supply. Now, your money supply is horizontal and fixed because the Reserve Bank operates and controls the money supply. But the Reserve Bank can manipulate the money supply in three ways. With regards to the cash reserve, the repo rate, and open market transactions. Right. So with regards to the cash reserves, a cash reserve is a reserve that the banks are required to hold. So if you go and deposit 100 Rand in the bank is obligated by law to keep in the bank account 2.5% of that 100 Rand. The rest they lend out, they make money. So if the Reserve Bank increases the cash reserve to 5%, it means that there are less money available to lend out for other consumers. So if there is less money available, money supply will decrease. Now, if money supply decreases, what happens to the interest rate? It increases. The repo rate, for example. If the Reserve Bank decides to decrease the repo rate, it means that it is the rate that the Reserve Bank charges the banks for money. So that means it becomes cheaper. Debt becomes cheaper. So if the banks are borrowing money from the reserve banks at a cheaper rate, then more money becomes available. So money supply will increase. If money supply increases, the interest rate will decrease. Open market transactions has to do with bonds. Now, I'm not going to go into detail with bonds, but what you need to know about government bonds is buy big, sell small. Now, what that means is if you buy, you go big. And if you sell, you go small. What this means is if you buy government bonds, money supply will go bigger. It will increase. And we have saw that if money supply increases, it will result in a decrease in the interest rate. And if you sell government bonds, money supply will decreases, which will cause an increase in the interest rate. And that is the demand and supply of money.